Welcome to the Explainer. Today, we're looking at a set of numbers that, well, at first glance, might just look like a totally standard, run-of-the-mill quarterly update. But if you look a little closer, they actually reveal one of the most fascinating business transformations happening in the world right now. We're doing a reality check on Alibaba's June 2026 earnings report, because right underneath the surface of these seemingly ordinary top-line numbers, there is a massive high-stakes AI story buried inside, and it has absolutely huge implications for the entire tech industry.
Let's start by anchoring ourselves with the sheer scale of this company. For the quarter ending June 30th, Alibaba reported 268.95 billion yuan in revenue. To put that into perspective, that's roughly $40 billion generated in just 3 months. Now, regarding broader market expectations, this number represented a 9% increase from the previous year, and it barely squeaked past what analysts were expecting. We're talking about a tiny beat of just 70 million yuan, which, for a company of Alibaba's immense size, is basically a rounding error. So, on the surface, no enormous surprises. But the composition of that 9% growth, that is where things get wild.
Okay, let's dive into this. This perfectly captures the core tension of the modern AI industry in 3 highly contrasting metrics. First, you've got that steady, mature, overall revenue growth of 9%. But compare that to Alibaba's AI cloud and compute business, which didn't grow by 9%, it skyrocketed by 45%. And then we hit the third metric. While overall revenue grew 9% and AI grew 45%, Alibaba's capital expenditure, the physical money they are spending to build all of this out, jumped an unbelievable 75%.
To really understand what's driving those diverging growth rates, we need to peel back the first layer. Section 1. The AI growth engine accelerating in the cloud.
There is a massive gap here between the traditional business and the future business. Remember, Alibaba isn't a pure-play AI infrastructure startup. They are a legacy tech and e-commerce giant. Yet the AI demand is clearly real, and it's translating directly into 48.44 billion yuan of rapid cloud revenue for the quarter. Management is actively positioning AI as their major growth engine, and they're shifting their cloud focus heavily toward proprietary models, AI compute, and agent services. This tells us definitively that enterprise customers aren't just, experimenting with AI anymore. They are actively paying for it, and they're using it heavily on Alibaba's cloud architecture.
So the crucial point is, capturing that surging enterprise demand doesn't just happen by magic. That brings us to Section 2, the billion-dollar catch, the reality of AI infrastructure. Remember that 75% surge in capital expenditure? Well, in a single quarter, Alibaba spent approximately 67.68 billion yuan. That is vastly outpacing their overall 9% revenue growth. Why is this so shocking? Because traditional software businesses usually scale with near zero marginal costs. But AI is completely different. Alibaba isn't just passively collecting AI demand. They have to actively build the hard physical computing capacity required to actually satisfy it. That means buying incredibly expensive specialized servers, building out vast networking systems, constructing massive data centers from the ground up, and paying for the enormous amounts of cooling and electricity required to run these sophisticated AI models 24/7.
This brings us to the central economic problem facing not just Alibaba, but the entire AI industry right now. Revenue growth does not equal automatic profit growth. Think about it. A 45% increase in AI cloud revenue sounds spectacular, right? But if you have to spend even more aggressively on computing infrastructure just to produce that growth, your overall profitability gets incredibly complicated. If your AI business doubles, but your underlying infrastructure costs triple, the returns on that invested capital are going to be severely squeezed.
And management knows this is kind of a runaway train. Alibaba had previously guided investors to expect a staggering 380 billion yuan of capital expenditure over a 3-year period. But CEO Eddie Wu recently issued a pretty stark warning they might actually overshoot that massive amount. That makes this quarter's aggressive 67.68 billion yuan spend absolutely critical to watch. They're basically signaling to the market that the infrastructure costs of the AI revolution are even higher and far more unpredictable than they originally modeled. If costs continue to balloon past estimates, well, it eats directly into the company's bottom line.
And this brilliantly illustrates exactly why they're willing to spend so heavily. Alibaba is not content just being the landlord renting out server space. Their strategy around the Qwen ecosystem aims to capture value at every single layer of the AI stack. Step 1. They build the proprietary underlying model, the Qwen family. Step 2. They provide the massive compute power to run it. Step 3, they host it all on their proprietary cloud infrastructure. And Step 4, they build the end-user applications. This creates a massive competitive moat. If you only sell compute, you're essentially selling a commodity. But if you own the foundational model and the application layer on top of your own cloud, you lock that enterprise customer into your ecosystem for years. It's incredibly sticky and vastly more profitable in the long run. But building out that whole 4-step ecosystem is a cash-burning machine. So how do they survive it? Section 3, 2 engines, 1 company, funding the AI investment cycle.
It really all comes down to a highly effective 2-engine strategy. Engine number 1 is Alibaba's traditional e-commerce business. This thing is mature, it's an absolute cash cow, and major events like the extended 618 shopping festival continue to reliably pump billions of dollars into the company's reserves. Then you have engine number 2, the AI and cloud business. It's high growth, sure, but it's an incredible cash burner right now due to those massive server bills we just talked about. But here's the thing, Alibaba has a profound structural advantage here. Unlike a pure AI startup that relies entirely on fragile venture capital, Alibaba doesn't actually need its AI business to be self-sustaining today. They can use the massive, predictable profits from their e-commerce engine to comfortably fund the intense investment cycle of their AI engine.
This dynamic leaves investors right at a crossroads. Section 4. Bull versus bear case, the market's dilemma.
Let's neutrally unpack the 2 scenarios currently gripping the market. Over in the bull case, the optimistic view, AI enterprise demand just continues to soar uninterrupted. The Qwen ecosystem gains widespread adoption and high-margin cloud revenue climbs. This leads to strong AI monetization, meaning that today's massive infrastructure spending eventually looks like a brilliant early investment that secured total market dominance. But we absolutely have to weigh that against the bear case. In this pessimistic view, capital expenditure stays elevated while fierce competition creates intense pricing pressure. Cloud price wars in China are notoriously brutal right now, with heavyweights like Tencent, Baidu, and Huawei all fighting tooth and nail for the exact same enterprise clients. If compute becomes a race to the bottom and customer monetization stalls, the returns on all that expensive infrastructure investment will just vanish. Investors could be left holding a highly unprofitable growth engine that constantly demands more cash.
So, what should you actually take away from all this? If you're tracking this space, treat these 4 metrics as your ultimate checklist for all future earnings reports. Number 1, AI and cloud revenue growth. If that 45% trajectory continues, Alibaba's strategic case remains incredibly solid. Number 2, Capex levels. If physical spending keeps ballooning past that 380 billion yuan guidance, the pressure to show immediate returns will skyrocket. Number 3, margins and cash flow. Generating massive revenue is great, but only if it ultimately translates into sustainable cash generation. And number 4, AI customer adoption. Because having an impressive foundational model like Qwen is completely meaningless unless real, everyday businesses are actively adopting and paying for those services at scale.
As we bring this explainer to a close, let's summarize the core contradiction. Section 5, the final verdict, growth versus payoff. The data clearly proves one thing for sure. Alibaba is moving incredibly aggressively, and the market demand for AI is entirely real. A 45% jump in AI-related cloud revenue verifies that enterprises want this technology today. But that 75% jump in capital expenditure verifies just how astronomically expensive it is to actually provide it. The core challenge is set. Alibaba still has to prove that today's massive, cash-burning infrastructure spending will successfully transition into tomorrow's durable, high-margin profit engine.
And that leaves us with the ultimate question for Alibaba, and frankly, for the entire global tech sector. How much is this AI revolution actually worth? Because if infrastructure costs continue to grow faster than the economics improve, the entire industry might be in for a very rude awakening. It's a fascinating puzzle, and one that sets us up perfectly for our next investigation, where we'll be looking at Baidu's highly contrasting numbers, a 25% AI growth paired with a 68% drop in profit. You really won't want to miss how they are handling this exact same dilemma. Thanks for joining me on this explainer, and keep an eye on those Capex numbers.